Now, every business requires to have accounting. In insurance, it is a promise to pay for a future event. When an insurance policy is taken, it is a promise by the insurance company that if some unexpected event happens and as a result of that event, the customer or the insured suffers a financial loss, then the insurance company will pay compensation or will pay for the amount of the loss. Now, this is a promise. Event may or may not happen. If it happens, the insurance company has to provide for it. So, for an insurance company, the providing for claims is most important. Accounts have to be rendered annually. At that time, certain details are required. So, the policy may not have run the full course. A person has taken insurance today. The policy will expire after 12 months in general insurance, but accounts will be rendered in March, so insurance company has to provide for. So we will see various types of reserving that insurance company does. What does reserving mean? Providing some amount towards payment of losses. So insurance company, what we will see in this session, the need for reserving, the need for making provision of funds to pay out for a loss. What is the amount when the reserves that are being kept, how those persons, stakeholders will be able to decide what is important to them. What are the types of reserves or provisionings? How the process of reserving works. The money is kept aside. In any business you will see general reserve, shareholders reserve, capitalization reserves. So this amount of money is set aside. It has to be invested in a proper manner so that there will be sufficient to pay out in the event of loss. And like all businesses, the general accounting practices have also to be followed. So we will now go through each of these steps of insurance. So what we see, delayed and uncertain costs. Why we need insurance reserves? We have to provide for losses. The premium is received today. The loss can take place any time from today to 365th day, that is the full year. So in general insurance, the event may or may not happen, but if it happens, the insurance company has to pay. Now, if we look at any premium, the premium rates are usually around 1% or less than 1% of the value for which insurance is being taken. So value for insurance is sum insured. The insurance premium is a small percent of that. So there must be sufficient to pay for the loss. So funds have to be set aside to provide for any loss that could take place. The loss could be a small amount of 10,000 or it go into crores. So these uncertain costs, because event has not yet happened, insurance company is on risk. They have promised to pay. The event can happen. They have to provide for that. So based on their experience, they have to make some provisioning for the losses. So the most important reserves that have to be done is for claims, losses. A loss has taken place, a property is destroyed, the customer or the insured has to be paid for that destruction so that they can restate or refunction again, financially put back in the same position and restart whatever business. If a person has incurred medical expenses, medical bills have to be paid. So claims are the most important reserves. In claims reserving, the claims technician has to see that it's followed, solvency is sufficient to pay out. We cannot reserve less. I would give you a simple example. When I first started in the insurance industry, I was in motor department, and one of the parts of motor department is motor third party. So compensations had to be paid to persons who were injured in motor accidents. The case has been filed in the court, and the court is now considering the case. So there were legal disciplines have involved. Every time the case came up for hearing, the party who is injured is submitting their requirement. The insurance company and the owners of the vehicles were defending. Finally, the court has to take a decision. So when we first started, we were making provisions of 50,000 and 75,000 because that is how the courts were giving coverage. Then legal judgments changed. Income levels started changing. So legal judgments also said that compensation for a person who has been injured, his future loss of income, we have to look at inflation and other aspects. So compensation amounts started increasing. So where we were initially providing only 75,000 for some major injuries, now we had to look at 2 and 3 lakhs as minimum reserves. So we had to make sure that our reserves or provision for such losses was increased to meet the demand as required or based on the decisions of the court. So what we have to, if we had not made those provisions, it could come to a time where the insurance premiums that we were receiving in each year would not be sufficient to pay out for all those losses. So every year, loss provisioning has to be made so that it does not impact on an insurance company's balance sheet to the extent that the insurance company becomes insolvent. So IRDA is very particular. As you know, the IRDA is the regulatory authority, is very particular that insurance companies maintain a solvency margin of 150%. But for motor, because of motor third-party problems, they have allowed a relaxation of 100 to 115%. Over a period of time, insurance companies will have to go to the 150 solvency margins. So provisionings are starting because of providing for the future. So how much reserve is important? The quantum of reserves, it should not be a small amount. It should be something, so when we are reserving, we have to look at it and analyze it carefully to make sure that this provision or money that is being kept aside for a future event will be sufficient. So we have to keep track of what is the trends in the settlements. We have to keep tracks on the values of properties and make sure that there is just sufficient, reserving should not also over-reserve. So both aspects have to be studied in detail. What would happen if we under-reserved? Maybe. Now we have seen market, soft market and hard market. So in soft market, we have seen that premium rates are reduced, more covers are given, and insurance companies try to take more business because they have a capacity. But it could come to a stage where there is undercutting. Today in the market, everybody hears of D-tariff. Premium rates now are not following tariff, and insurance companies are charging very low premium rates. Now insurance companies charge low premium rates is fine, but if losses start increasing, those low premium rates will have an adverse effect where there will be not enough money to pay out for the losses. So under-reserving has to be carefully observed, and a company from the reserves, if a company is having excessive growth, a growth is a good thing, but a growth of too high, if a business growth is too high, the worry is that there could be something going wrong. The reserves may not be sufficient, and there is a tendency, because excessive growth, we are unable to provide for what are called long tail liabilities. Legal losses, legal claims, where decisions are made by courts. As we all know, courts take years to take a decision on a loss. So when we look at liability insurance, when we look at motor third party, we find that these liabilities, by the time the court judgment comes, it may be 15 to 20 years. So my provisioning at 10 years ago may not be sufficient today when the judgment is coming. So long tail liabilities are worrisome factors, and we have to make sure that there is sufficient buffer provisioning or funding to pay for such losses. Another, excessive growth has another effect. Reinsurance may not be proper. Many of you would have heard of financial companies going bankrupt in America. One of our major insurance companies was AIG, internationally well known in the insurance market. They had financial problems. So while here we saw a problem of excessive growth where insufficient funds were there, and when the losses started mounting, they realized that they did not have sufficient to pay out for all those losses. So what happens? Underpricing, reduced rates could impact future. So that is why reserves must be carefully studied and arrived at so that there is sufficient buffer to pay for the losses. Now all of us in our day-to-day work, we have to budget within our income. We cannot exceed our income. Similarly, insurance companies, but we have to provide for some, if there's a medical emergency or there is some other emergency or there is a job loss, we have to have sufficient funds to manage our day-to-day home till we get another job. And in a market where jobs are scarce as it is today, where previously we could have provided for just 2-3 months, now we may have to provide for at least 1 year's income to run the home. So all of these similar things that we do at home, an insurance company has to do to provide for the future. So these are similar types of reserving. Who are the stakeholders who want to see how the reserving is done? The most important are the shareholders. They have invested to earn an income. They look at the profit where they will be sharing in it. They also do not want their company to grow and be viable. They do not want that 2 years down the line the company goes bust. So they are looking at viability. So reserves should be adequate to give them a return, as also to have a company that grows over a period of time. So viability, and so there must be sufficient funds, the solvency, to take care of this shareholders. The government also has a stake. Why does the government and the regulator? The government has a stake because the government knows when we are in the insurance sector, it is a promise to pay. If insurance companies refuse to pay claims, the policy holders will lose their belief and trust in insurance companies, and the government will also be the losers because insurance would not provide for losses. The government would be receiving so many complaints, and insurance companies' names will be destroyed. Similarly, the government also wants to make sure that insurance companies have sufficient money to pay out claims. There must not be corporate failures because businesses going bust is very bad. Jobs are lost, economy suffers, markets are destroyed. So government has a vested interest in ensuring that all stratas of society are protected with the reserving provisions. If reservings are not sufficient, a lot of problems would arise. The government is also interested in something else, and that is taxes. Our government earns revenue to run and to manage, administer the nation and to administer the society through taxes. So government also does not want too much of reserving, over-reserving, so that insurance companies will pay lesser taxes. So there should be an equal amount of reasonable taxation, and also growth of the sectors. So jobs grow, economy grows, and opportunities grow for everybody. The underwriters, they need to see what the reserves are because they have to work out premium rates. What are the reserves? We are providing for losses. So actual losses that have incurred is giving us the pure premium. To that we have to add a lot of expenses for what is going to happen in the future. So all of these which we saw in the earlier class about how premium comes through. So basic losses plus provisioning for the future, the underwriter has to see that and then decide whether they are willing to accept these risks, whether the premium rates that he is quoting for some proposal is adequate or not. So underwriter looks at the reserves with this element that the premium is sufficient. There may be some case histories of unexpected losses, major losses. So he looks at those figures also and sees that whether if such an event takes place, we will have sufficient, my premium rate is adequate to cover all my clients. So am I having too many clients in one category, in one location, where the exposure to an earthquake or a natural disaster is great and it will have a major impact? So what the underwriter will look at? Spreading of similar natural risk across the country, so no single location has a major impact. all of those will come from the reserves. The figures that are shown in the reserves will help the underwriter to then work out a rate. So if he finds that the amounts of premium and the probable maximum losses that could happen are more than 50 or 60%, then he knows that he has to be careful. He may decide not to accept the risk. So underwriters have a stake, have an interest on seeing how much is the provisionings for various reserves or providing for funds for future events. The insurance company managements are also interested. They have to see profitability. From the reserves they can see, they can observe what trends are taking place, what is the nature of the risks that are there, what was the old risk and how it is changing. It is also gives an early warning. If a study of the reserve of provisioning can give a warning whether we have sufficient funds or not to pay out future losses. We all know global warming is having a major effect in our country. Storms are very severe and a lot of damage. Flooding is taking place in new areas and massive flooding. So what happens is all of those properties, claims are being paid out. So those claims that claim ratio is climbing. That is, the amount of claims versus the premium received is rising, the percentage wise. So then insurance companies have to decide what is to be done to make sure if these kind of losses continue to happen, our premiums may not be sufficient. So premiums may need to be increased based on changes that are taking place. Wherein in the 1970s and 80s, there would be once in 3 years a major cyclonic disaster causing lots of property damage, insured property damage. Now we find that almost every year there's a cyclonic storm causing destruction of property. So the risk is now become a little greater. Premium rates should take into account these factors, and so the reserves to pay out for such losses also have to be provided accordingly. And that is why the management looks at these are problems, our reserves are not sufficient, it is time to increase the reserves or make sure premium rates are not too low, raise premium rates or put in some conditions so that our losses are kept under control and premiums do not get so excessive that customers do not take insurance, because not taking insurance also means that the funds that will be available to reserve will be insufficient. The third aspect now, the types of reserves. So one is known as the premium reserve. The first premium reserve is unearned premium reserve. What is unearned premium? During the course of a year, policies are being issued. But an insurance company and all organizations have a fixed financial year. So what happens is, an insurance policy that will run in general insurance, which runs for 1 year, will impact 2 financial years. So at the end of the first financial year, there is still some element of the policy period still running. Loss may not have taken place till now, but it could take place for the balance period. That's the next financial year. So an insurance company has to provide that this risk is still not over. Till the last day of the policy, a loss could take place. So the premium that we have received cannot be shown as full profit to us because the financial year is over. The policy year is still running. So what the normally insurance companies do, they deduct all their costs. The net premium that is there will then be divided and calculated for the balance year. So to that extent, we are still on risk. So that amount premium is not yet earned. It is there, it will be earned only when the policy ceases. So per day or per month they can work out as policy gets over, that premium, that element of the premium, it can be now added to profit, but till that time it is as an unearned premium. So this is the unearned premium. Unexpired risk reserve. Now this practice has been discontinued in most insurance companies. What would happen was, an insurance company would make a provision for a loss. And because it was a soft market, they would provide less. Premium rates have gone down, they would provide less and they say, we will see if it happens. If the risk or loss takes place, we will see. Now subsequently, the risk increases. So the provisioning may have been made for 1 lakh for a particular loss or for an event, but the actual loss turns out to be 4 lakhs. So the difference between our original provisioning of 1 lakh and 4 lakhs, that's 3 lakhs, will have to be added as unexpired risk here. So a risk that was there, which we did not provide for full amount, we have to now provide for. So this was a concept that was followed in the past. Now insurance companies have been dissuaded. Regulations have come in to make sure that you do not do such things. You arrange for premium, because shareholders also want to see what is the operating profits. So providing less will impact the next year's financial statements. So it is always necessary to make sure provisions are adequate. And so unexpired risk reserve is not continued. Claims reserve. So the claims reserves are first outstanding claims reserve. When we say outstanding, a claim is reported, an insurance company has recorded it in their books, and the process will start now for the arriving at the assessment of the loss. So outstanding claims reserves. So there will be 2 types. One is what is called open claims reserve. That is, the claim is reported, a provision is made, and this provision will be updated based on figures that are coming in. So we have got information about the loss. The insurance company, according to their experience, has estimated the amount of loss and provided for it. The second is known as incurred but not reported, or IBNR. Now IBNR is a loss that has occurred but not yet informed to the insurance company, or likely to be occurring and not yet informed. So IBNR is based on a lot of subjective information and past experience, and for that amount has to be provided. Sometimes the policy is expiring on the last day, the financial year ends on 31st March. A loss has taken place in the last few days of that month of March, but the claim is not informed to the insurance company in the first week of April or in the middle of April because of communication problems. So it should actually go in the last year's claims figures as an outstanding provision, but it has come subsequently. Accounts are already being finalized. So insurance companies from practice provide for such provisioning called IBNR to take care of such losses. So this also has to be provided for, that we will be required to pay a claim in future. The claims equalization reserve. This is a unique reserve. Normally what happens, we do not follow it in India. This was a practice in countries where the insurance companies are free to have freedom in functioning in all aspects. There is lots of competition. So what would they do is, claims which have occurred, they have made some provisions. In a soft market, they may not have made as much incurred losses provisioning because premiums are very low. Or when market is doing well, profits are good, they may provide more because profits are there. We can set aside for a time when hard market and profits are being impacted. So if incomes are high, we may set aside a little extra money to provide for a market where times will be tough and premiums may not be sufficient to cover losses. So we make a provision now. So we create a reserve for future hard times. So those claims, these are called claims equalization reserve. All of these are essentially fund provisions to pay out for losses. How does the reserving process go? For small risk of commoditized products like package policies, householders package, shopkeepers package, motor insurance, these are packages. For small SMEs, these are small risks. So the historical data will give us a picture. What is the experience over the period of time? The growth will be very, very similar and small. So So we provide for these reserves based on that factor. But when we have large and complex risks, now we have to look at these provisions for these losses carefully. We have to look at our past experiences. We have to look at market trends of the future. We have to look at the impact that this loss has on the economy and other aspects. All of these are taken into account. So this is based on an experience. So the person making provision for large risk will have based on experience, and also keep checking during the course of as the claim is being processed, revisiting the provisioning and seeing whether it needs to be increased or it has to be decreased. So it will be constantly monitored to show the picture is adequate. So large and complex risk requires constant observation to ensure that nothing is forgotten and its impact would be reduced. Otherwise, it could be a major loss and everyone could be in bad. It would be a very bad financial loss to the company. They could make major losses. Now, after all these data is collected of claims provisions based on past experience, the commoditized claims, we have worked out a figure of provisioning. To that, we have added the large and complex risk provisions. All this data is collected. It is then divided into practical subclasses. Subclasses means standard classes for each of those products. So we look at home policies or home policies issued for Mumbai or home policies issued for Pune. So commoditized products for various regions, depending on what we are looking at. Are we looking at natural disasters or we are looking at individual particular types of losses? So these subclasses will be created. They have to be similar types of risks. So I gave you an example. It could be natural risk of Mumbai, it could be natural risk of Pune, or it could be particular region of India. So all of these will be collated and formed into subgroups. Subgroups which sufficient group size, not too small, not too large, so that we can work on the statistical data and arrive at a reasonable provisioning. So when we work it out, then we will add on what is called the incurred but not reported. After we have worked out all of these factors, we come to a particular reserve which can be audited by an auditor to see, okay, these are the types of losses. You have motor third-party commercial vehicles. These are the kind of third-party losses taking place. In this region, it is coming to this figure. So provide in this manner. The courts in a particular state are being very liberal in compensation amounts. Provide for that. So all of these data has to be homogenized to particular things to work out an adequate reserve. So the more data and the more correct data we have, it becomes easier to provide and to work out reserves. A small amount of it, looking at just 10 policies is not sufficient. We need to look at a bigger group so that we can spread it and work out a proper reserving. So we see the process of reserves. A very common form of reservation is called the triangulation or chain ladder. You will find it in your textbooks. So what do we see? There is a claims paid in lakhs and the year of development. So we have the first year 1997. In the first year of that claims reserve, we have the first year 938. So the year in which the claim is reported. And then as the claims are being settled, in the first year some claims settled, in the second year further from that particular year of losses 1997, over a period of time you find that by the 7th year we are down to a low figure. So what you find in this triangle? Experiences, so when we are in our latest years, 2004, we are in the current year 2004, the loss is only for the first year, the loss is reported. Over a period of time, the amount of loss settlements, the provisioning will be reducing for those years. So based on these figures, looking at these figures, the provisioning for reserves would try to fill in that this is how it is growing by 8% or it is reducing by 15%, the number of claims are increasing by 7 to 15% or settlements are going at 8 or 9% on an average every year. So in that manner we can see about our reserving. So we fill up, working out a formula, we fill up this based on this triangular mathematical data, we work out some figures through extrapolation and arrive at what provisioning should be there for the balance years to come. Now this is just a mathematical calculation and modeling. Adjustments have to be made. Once we work out these, from these mathematical data, we work out some rating and reserving, we have to adjust for inflation. We have to adjust for any further rebuilding costs. We have to adjust for legal framework. We saw that when we were looking at our premium rates too, that we have to provide for future legal laws changing, higher compensations coming in on new types of legislations, court decisions which change the amount. So in past motor third party court decisions, 50 to 75,000 were settlements. Today we are looking at 10 and 12 lakhs on a minimum for motor third parties. So provisioning has to be made. The time trends are towards increasing amounts of compensation. Medical costs of medicines, technology, there's robotics coming in. So medical claims are rising because of the use of robots, new technology. So all of these have to be provided for when we are looking at our provisioning for the reserves, for the claims payouts and for other reserves. So after we have calculated the mathematically, we have worked out the reserve, we have adjusted, we have added for these adjustments, we go back and recheck. All the data that we have, can it be trusted? Is it correct? Do we have sufficient data? Can we be very certain about the sources of our data and this information? Can we club these data into groups, homogeneous, so standard common groupings can be made of sufficient, the group size sufficient so that we can work out a conclusion, and not only on the past, look at past, but also can we provide and extrapolate for the future. What is the future outlook going to be? Are these going to be standard types of losses? How do we project, the method of projection? What type of projections we should do? What types of, the same data could be projected for various different categories. It could be state-wise, it could be region-wise, it could be geographical region-wise, it could be income level-wise, it could be the business types of business practices-wise. All of these could be taken into account to work out our reserves. So reserving requires, normally in reserving, all the figures are obtained and the actuaries will then get to work on the strategies. So reserves have been created. But just having money in the bank, you won't want to keep money in a current account because it doesn't earn anything. Similarly, for insurance company, the money that is kept in reserve is a considerable amount of money. It should be invested in such a manner that they get, the risk is minimal and yet a return that is enough to cover and provide for any future eventualities. So how do insurance companies, there are various modes of investments. One is known as the modern portfolio theory. So investment in a portfolio which would comprise of equity, it could be debt, it comprise of scheduled publicly listed investments, privately listed, unlisted investments. A combination of all of these could be there. But it must be in such a manner that it is not, because it is a reserving. We cannot afford to lose this money. So there should be a return and also a risk protection. It should not be that we can lose because it's a huge amount of money. There should be no loss. So the portfolio has to be seen in the full context. Now when we say the portfolio, we also have to see that this money is going to be used for what purpose. This money reserve is kept aside, say, for motor third party. We know that the judgments will not come quickly, so we can look at a little longer term. But if we are looking at fire losses or flood losses, the money will have to be paid out within a year or maybe a year and a half. So that portfolio for those losses, that reserving should be sufficient that we can liquidate it and make the payments for the claims. It should not be somewhere while in the process of liquidating we lose. So reserving, modern portfolio theory says a proper mix of all types of investments to make sure that a return generated, so income is generated, and we take this into account when we provide for our reserving. That a return on income also is coming in. To that extent, we can reduce the reserving that we may need. Then asset and liability management. In banks, you hear of it so frequently. Long-term deposits versus short-term liabilities don't work. So short-term liabilities and short-term deposits, they should go concurrently. So each should protect the other. So you in insurance, in life insurance, these are long-term, so you can look at a very long-term liability. But in general insurance, we have to see that it's an annual policy, losses can come immediately. So we can't look at 10 and 12 years. We have to look at 3 to 5 years in most cases. So we have to, our balance sheet of asset and liability have to match for both interest and liquidity. We must have the money when we need it, liquidity, and we must also be in such a manner that we can get the most fine interest rates or the most fine incomes from the reserves. In India, investment of insurance reserves are decided, there's a pattern laid down by regulation. So the IRDA, the Insurance Act 1938 and IRDA's subsequent additional regulations have specified how reserves have to be invested. So reserves are going to be invested in variety of products, central government investments in central government schemes. At least 20% for central government schemes. In investment in state government funds. So central and state together at least 30%. So our reserves must go there. Now what is the impact of this? When we invest in central and state government, the community benefits. So there are two advantages: a return, a safe return, and also development of things for state and central, which means community development. Housing, loans, and loans to states for housing, as well as firefighting. Some reserve has to be kept, and that is 5% must go for these packages. Approved investments. So IRDA has listed certain schedules, what are approved investments, and those have to be in infrastructure, 10%. IRDA has approved certain infrastructure funds where investments can be kept. That is also maximum 10%. Then there are others approved securities of public listed companies, unlisted companies, again up to less than or equal to 30% or less than equal to 25%. So the investment mix has to be a combination of all these. Now see, central government, state government has to be not less than 30%. In addition, housing finance and loans to state government for housing and firefighting should not be less than 5%. So what we have, 35%, is more or less assured into various categories. Then we have for infrastructure another 10%. So what you are finding, 45% of reserves are going into very specific, safe avenues to ensure solvency and reserves. So these are regulations laid down by the IRDA for investment strategies. So money has been kept aside, they have to be invested, returns on that will help the insurance companies to meet their liabilities. Accounting has to. So general accounting practices have to be followed because it's a company. They have to follow the accounting practices. What is the general accounting practices? Balance sheet. So insurance company draws up a balance sheet. They draw up the profit and loss account. They have a cash flow statement that has to be done. It's a direct cash flow. So there is a slight deviation from normally investment as required under the Institute of Chartered Accountants for accounting practices, that insurance companies investments are not to be declared because investments are done according to a norms laid down as per the regulation. Now, but if you see, an insurance company has to give segment reporting. If any of you have seen an insurance company's balance sheet, you will see premium figures for fire, for marine, and for accident. There may be sub-units, again, a health, liability, and other sub-units, but the three broad reporting revenue models are fire, marine, accident, miscellaneous. So they'll be showing, what will be shown? How much premium has been earned, how much commissions have been paid, how much claims have been settled, claims paid as well as provisioning for the claims already reported, the expenses of management. If there is co-insurance, when other insurance companies have also got a share, to how much is that extent of co-insurance. Reinsurance, so incomes from reinsurance as well as liabilities on reinsurance. Investment income and foreign operations incomes. All of these are shown as separate segment reporting in an insurance company's balance sheet. So these are the general accounting practices an insurance company provides. In the premium for accounting is taken as income, but there could also be an advance premium received where the risk has not yet incepted or completed. We saw that premium reserve. So it is shown as not as an income, but it is shown as a liability. That until the policy period is over, that will be a liability. So it is shown in reserves as premium reserve. The cost of acquisition costs includes commissions and all other expenses incurred in getting business. Claims paid, so they have what is already paid, what is outstanding which has to be paid, then incurred but not reported, incurred but not expected and reported, so IBNER, there too there's a provisioning to be made. Investments, what investments and how the income is being earned from investments. Any loans have been given, the loan statements have to be given, and catastrophic reserves. So a reserve has to be provided for unexpected major losses or catastrophes. We have heard this word frequently. Normally catastrophes are looked at as natural perils like earthquakes, cyclones, floods, major floods, and also social perils like terrorism and riot strikes on a massive scale. So these are all cat losses. So catastrophes have to be provided for. So all in accounting of insurance, the picture of accounting is this for an insurance company. So with that, we find we have finished our last chapter on insurance.